Hello and welcome to another video of this course. This is Module 9, Oil and Gas Taxation, and we're going to be looking at the importance of oil and gas taxation, types of taxes in the oil and gas sector, tax incentives in the oil and gas sector, deferred tax accounting in the oil and gas sector. So what is oil and gas taxation? Oil and gas taxation refers to the specific tax policies and structures applied to the exploration, production, and sales of petroleum resources. Due to the strategic and lucrative nature of the industry, governments often use taxation as a key tool for generating revenue. Oil and gas taxation involves specific tax regimes applied to companies engaged in exploration, production, refining, transportation, and marketing of petroleum products. The taxation framework varies by country, but generally distinguishes between upstream, midstream, and downstream operations. Now let's look at the importance of oil and gas taxation. Oil and gas taxation plays a critical role in the governance, economic development, and resource management strategies of oil-producing companies. It serves as a tool to ensure that the nation and its people derive meaningful benefits from the exploitation of finite natural resources. So let us look at the importance of oil and gas taxation under the following headings. It is a source of revenue generation for the government. So it serves as a primary source of income in many oil-rich countries, especially in developing nations like Nigeria. Oil and gas taxation constitutes the largest single source of government revenue. It also helps in funding public service because the revenue generated is used to finance critical sectors such as healthcare, education, infrastructure, security, and social welfare. Diversification support. Oil tax revenues can be channeled into developing non-oil sectors like agriculture, manufacturing, and technology. Another importance is resource ownership and sovereignty. Taxation is a way for the state to assert ownership rights and to ensure that private or foreign entities exploiting these resources contribute fairly to the commonwealth. Through taxation, the government also enforces a system of economic justice. This ensures that the exploitation of public resource benefits the entire nation and not just corporations or the elite. We also have economic stabilization and fiscal policy tool. Oil and gas taxation serves as an important macroeconomic management tool. It allows governments to influence investment patterns and control economic fluctuations. During booms, increased tax collection from the sector can help regulate inflation by absorbing excess liquidity. And during downturns, tax incentive or temporary reduction can stimulate continued investment in the sector. Another importance is that it encourages efficient resource utilization. Carefully designed tax systems encourage responsible exploration and production. For example, royalties can incentivize companies to maximize output, and profit-based taxes motivate companies to control costs and operate efficiently. Taxation frameworks can also discourage waste, environmental harm, and speculative behaviors by making unproductive or environmentally destructive practices unprofitable. Another importance is attraction of foreign investments. A stable, transparent, and predictable tax regime in the oil and gas sector signals a friendly investment climate. Although taxation is a means of revenue extraction, balanced fiscal systems can encourage international oil companies to bring capital, technology, and expertise into a country's petroleum industry. Another importance is promotion of accountability and transparency. Effective tax administration promotes government accountability, especially when the revenues are transparently collected, reported, and utilized. Another importance is environmental and social regulation. Taxes can be used to penalize environmental harm, and fund remediation activities. We also have redistribution of wealth, national economic planning and forecasting, support for legal and regulatory frameworks. Now, there are different types of taxes in the oil and gas sector because of its unique nature. It's capital intensive, high risk and high reward. And this makes it subject to a specialized taxation system that differs significantly from other industries. The different types of taxes are categorized into the following. We have royalties. A royalty is a payment made to the government based on a percentage of gross production or revenue, regardless of whether the company is making a profit. We also have petroleum profit tax. This is a profit-based tax levied on the income of companies engaged in upstream petroleum operations, and it only applies to upstream operations such as exploration and production of crude oil. Petroleum profit tax is also one of the most significant sources of government oil revenue in Nigeria and some other petroleum-producing nations. Another category is companies' income tax, CIT. CIT is the general corporate tax applied to profits of non-upstream companies, such as those involved in gas processing, refining, petrochemicals, and oil servicing. It only applies to natural gas processing and transmission companies and downstream oil operators. Another category is education tax, EDT. EDT is a tax imposed on all resident companies for the development of education. Another category is withholding tax, WHT. WHT is a prepaid income tax withheld on certain payments such as dividends, interest, royalties, rents, and fees for technical and consultancy services. It ensures government tax collection on income repatriated abroad or to third parties. Another category is customs and excise duties. Customs and excise duties include levies on the importation of equipment and materials, and sometimes on the export of refined products. They are applicable to most capital imports for upstream operations and may be exempt under certain incentives. We also have the Niger Delta Development Commission, the NDDC levy. This is a mandatory contribution to fund development in oil-producing regions. It is aimed at addressing environmental and developmental impacts of oil production in the Niger Delta. We have Nigerian Content Development Levy, the NCD levy. The NDC tax is a levy to support the Nigerian Content Development Fund, enhancing local participation in the oil and gas sector. We have the hydrocarbon tax under PIA. The hydrocarbon tax is a new tax introduced for companies engaged in upstream crude oil activities. It is applicable under the Petroleum Industry Act of 2021 and coexists with CIT and replaces PPT under the new fiscal framework for companies obtaining to the PIA regime. Now, let's look at tax incentives in the oil and gas sector. Tax incentives in the oil and gas sector are fiscal tools used by governments to attract and retain investment, promote exploration and production activities, stimulate economic development, and increase local participation. Incentives include tax holidays, capital allowances, duty waivers, deductions, exemptions, and investment credits. And they are structured to balance the interests of governments and companies seeking revenue and profit, respectively. But what are the objectives of tax incentives? Number one, to attract foreign direct investments, to stimulate exploration in high-risk areas, to promote local content and industrialization, to encourage gas development as an alternative to flaring or underutilization, to support marginal fields and small players, and to enhance technological transfer and employment. So the major tax incentives we have in the oil and gas sector are capital allowances, and these are deductions granted for capital expenditure on qualifying assets such as rigs, platforms, pipelines, building, and equipment. We have the investment tax credit, the ITC, and investment tax allowance. This is granted as a percentage of qualifying capital expenditures. We also have tax holidays or pioneer status, which helps encourage capital-intensive investments during early unprofitable years. We have gas utilization incentives, and these promote gas development due to its cleaner energy profile and its historic underdevelopment compared to oil. We have waivers of import duties and VAT. Oil and gas operators often enjoy custom duty exemptions for importing equipment used in upstream operations. We also have decommissioning and abandonment cost deductions. This is where government allows the deduction of decommissioning reserves and costs to promote responsible field closure. We have rig fencing rules and incentives. Rig fencing limits the consolidation of profits and losses across projects. We have uplifts on qualifying capital expenditure. An uplift is an additional percentage granted on capital expenses when calculating cost oil or deductible expenses. We have reduced tax rates for specific fields. We have production allowances, and more details on that will be seen in the slides. So, tax incentives under Nigeria's Petroleum Industry Act. The PIA introduced a modernized fiscal regime, replacing PPTA, and introduced hydrocarbon tax. The CIT under CITA continues to apply. We have cost deduction limits, royalty incentives, zero hydrocarbon tax on gas income, decommissioning funds, and contributions. So let's look at the risks and considerations. While tax incentives promote investments, they come with risks. And among those risks are revenue loss, inequity, complexity, and abuse. Under revenue loss, overgenerous incentives can significantly reduce government earnings. Under inequity, local operators may lack access to the same incentives as IOCs. Under complexities, multiple incentives can complicate tax administrations, and weak regulation may lead to tax avoidance. Finally, we'll be looking at deferred tax accounting in oil and gas. Deferred tax accounting arises from differences between accounting income and taxable income. In the oil and gas industry, these differences are especially significant due to the sector's capital-intensive nature, complex cost structures, specialized tax rules, and long-term investment with delayed returns. And the goal of deferred tax accounting is to match the income tax expense with the period in which the related accounting income is recognized, thereby improving financial reporting. The key concepts in deferred accounting are temporary differences, deferred tax assets, deferred tax liability, and tax base. So let's look at temporary differences. This arises when an item is recognized differently for accounting and tax purposes. Deferred tax accounting is recognized when future taxable income will be reduced to the deductible temporary differences. And deferred tax liability is recognized when future taxable income will be increased due to taxable temporary differences. And then the tax base is the tax value of an asset or liability used to calculate deferred tax. What are some of the common sources of deferred tax in oil and gas accounting? We have capital allowance versus accounting depreciation. We have decommissioning liabilities, exploration and evaluation expenditures, and revenue recognition, as well as losses carried forward. So quickly, we'll be looking at the challenges in deferred tax oil and gas accounting. They include uncertainty in tax laws and reforms, volatility of oil prices affecting profitability and recognition of DTAs, long lead times between investments and productions, ring fencing rules that limit the use of tax losses, currency exchange fluctuations affecting tax bases in some jurisdictions. Knowing this, what are the best practices for deferred taxing in oil and gas accounting? Regularly review temporary differences and their tax impact. Maintain separate deferred tax schedules for each tax regime. Consider the probability of future profits before recognizing DTAs. Reflect tax changes immediately in deferred tax calculations. Align accounting policies with IFRS and GAAP requirements. Thank you very much for watching this video. I will see you in the next video.